Hello and welcome to the Calibre Investment April 2023 quarterly briefing, where we'll cover the first quarter of an eventful year so far. So there's been a lot going on in markets and around the world, so we'll just look at a couple of key topics that will be important in terms of portfolios and our end client objectives. So we'll cover off today inflation, how central banks are targeting that, and how those actions are impacting on the global growth. From there, we'll look at the markets and how those topics are impacting in the portfolios. So one of the main conversations in 2022 was inflation, and this year is no different. Inflation remains very high. It's multiples above the central bank's respective roughly 2% targets. If you look at the US, where inflation peaked at 9.1%, you'd have to go back to the 1980s to see those same levels. And here in New Zealand, inflation levels, you'd have to go back to about the 1990s. Now, importantly, the underlying factors of what's driving this inflation are changing. So initially it was the price of goods. Price of goods was increasing, and that's what caused inflation to peak initially. So if you go back to the early 2022, used cars, for example, they were selling for higher than their new values, and that's as of supply disruptions and supply change, which then caused a global shortage. Now what we're seeing is that service inflation is increasing. It's becoming a larger proportion of headline inflation. So that's things like rent and airfares, for example, and that's reflecting a shift in household spending. So add to that the severe weather events, and that's both here and abroad that we've experienced recently. Now they're going to add inflationary pressures again. And that's going to be particularly the case in things like fruit and vegetables, so those farmlands that have been hit hard, as well as construction when areas look to rebuild. And it's that change in underlying factors that mean that inflation remains persistent. So over the last 12 to 15 months, in New Zealand, for example, inflation hasn't really changed that much. And it's the fact that it's not shifting that we're going to be in this higher inflation environment for longer. Now, where inflation is so high and persistent, over the last 18 months, central banks have been raising interest rates to try and dampen the demand and bring those inflation levels down. Recall here that they're taking off from very low emergency settings, and that's thanks to the global pandemic, but they're increasing at a rate that we haven't seen since the global financial crisis back in 2008. So this has been one of the fastest financial tightening periods in history. So why the rush? Well, importantly, central banks are not just targeting inflation levels, but also inflation expectations. So if people expect that higher inflation will be a problem, they ask for higher wages to be able to afford everyday goods. Now these higher wages, to compensate the cost of living, then get pushed through to the consumers, and we see higher prices of goods and services coming through, and that fuels the wage price spiral. So to date, US and local labour markets have weathered these rate rises well. They're tight labour markets and they remain low at historical levels in terms of the unemployment. The challenges that owners faced with businesses as they reopened from global pandemic restrictions has meant that they're wary of letting staff go too soon. Combine the readily available jobs and wage growths, and we're seeing that US retail sales have increased. Consumers are out spending. Therefore, in order to bring inflation down meaningfully, central banks are going to have to cause some pain in the economy, and that's going to translate into a higher unemployment rate. However, the central bank tool of raising rates is rather blunt, so it doesn't have the ability to target individual industries or sectors, and that means that there'll be some areas that'll feel the pain more than others. If businesses are able to push on these increased costs on consumers, they'll generally fare better in this environment. The other impact that the central bank rate rises have had is, for example, things that we've seen in the banking sector recently. Those increases in rates have an inverse relationship for companies that are holding bonds and debts, and they actually see the bond value fall. Similarly, homeowners will feel the effects as they notice the lower rates that they've fixed their mortgage at in those COVID pandemic times as they roll off into new higher rates. The other challenge that central banks have is that monetary policy often works with a lag. So traditionally it takes 12 to 18 months for these impacts to come through, meaning that we're yet to feel the full effect of those rate rises that have already been delivered. And in that sense, the Reserve Banks are driving as if they were looking through the rear windscreen. And this has meant we're seeing some divergence across central bank actions as they each try and navigate the path ahead. So some central banks are pausing, for example, the Reserve Bank of Australia, whereas others are still increasing rates, albeit at different magnitudes. It's not surprising then that in terms of a recession, some countries will fare better than others. Forecasts favour the US, that's the world's largest economy, to avoid a recession, while estimates for the euro area have revised their forecasts upwards on a milder winter than anticipated. The UK, which was tipped to enter a recession early this year, looks to have postponed that recession until later on, while in New Zealand, forecasts are for a recession that lasts several quarters. And as the developed world is flirting with a recession, China is on a different path. After experiencing protests and civil unrest, they've done a complete U-turn on their zero COVID policy and reopened in rapid fashion. So as we see increased demand from China, this may help to offset some of the global slowdown from more advanced economies. So to recap, inflation is high, the underlying factors are changing, and that means inflation's remaining persistent. Central banks are addressing inflation levels as well as the inflation expectations, alongside historically low unemployment levels, and they're using a blunt tool of raising rates to achieve this. The challenge in navigating this environment is resulting in divergence across central bank actions, and it means that we'll see varying results in how countries fare against a recession. While China's growth is going to help offset some of that slowdown that we're seeing from advanced economies. And with that, I'll hand over to Mark for the market and portfolio update.
Well, thanks for that, Gemma. As we can see, the markets and hence the portfolios are still driven by these big macroeconomic events, namely, the big inflation issue, where interest rates are going off the back of that, and then what market reactions to those drivers are. And now the big driver, of course, is, are we going to have a hard or a soft landing? Meaning, are we going to have a deep or a relatively light recession, which is just more than a slowdown? So looking at the equity markets, we've had a much more positive period than in 2022, which was a bit of a horror year. The 3-month and 6-month numbers, as you can see on the slide, are pretty positive after that period. Global equities have performed pretty well. As you can see, New Zealand's done quite well over the last 6 months, but that's coming off quite a low. So that's been a good feature of this last quarter as well. It's been a bit up and down. January and February were pretty good. March not quite so good, but overall the quarter has been pretty positive, as you can see by those numbers. And even cash and fixed interest have recovered a bit. We've seen interest rates pick up quite a bit as the central banks have continued to tighten. That's meant that the term deposits have picked up as well, and people are actually reacting to that in terms of their investment choices and so on. The big change, of course, has been what we call New Zealand sovereign and global bonds, which are essentially your government bonds issued both in New Zealand and overseas. 2022, again, was a pretty tough period for bond investors because on a mark-to-market basis, as we illustrated in the past, it was a pretty negative outcome. And so So this period has been far more positive because unfortunately with the prospects of recession, bonds have actually rallied, and that interesting situation where interest rates fall but the value of your bonds go up. So that's actually occurred over the last 3 months and 6 months, which has been a much more positive period to be holding bonds. It has been a really interesting period for commodity markets. The prospect of recession has seen things like oil and so on come back, but of course we've seen OPEC restrict output because the main drivers in OPEC, the main countries in OPEC, are wanting to maintain a price level which is higher than where we were headed when they had higher levels of production. So they've cut production, but even so, what we've noticed over the last few weeks is that those oil prices have still continued to come back a bit more. And again, that's the prospect of recession. But what we're starting to see now in commodity markets or in the oil markets is actually demand isn't really meeting supply. So that may be the early signs of people really slowing down. But we'll see on that one. Generally, commodities have come back outside energy and outside oil, again for the same reason that the prospect of recession is weighing on people's minds. But the other big driver is that supply chain issues that were prevalent after the pandemic have started to wash through the system, and so shipping costs have come down and so on. So that's actually improved the actual cost of commodities. Of course, the situation in Ukraine hasn't improved at all, and so that still weighs on commodity prices as well. Of course, nobody knows where that's going and how long that will continue for. But while that war continues, there's going to be obviously increased uncertainty about what the impact on oil prices and commodity prices are. Because as we know with Ukraine, that not only affects oil and gas, but they are very big food producers as well. And so there is that compact, that accord with Russia in terms of the ability to export those food commodities, because there were real concerns about famine in certain parts of the world, namely Africa and so on, if they weren't able to get those grains and so on out. At the bottom of that slide there you can see PIC, which is the commodity producers in the index, and that's, as you can see, that's hard metals. They're going actually relatively well because you've got actually activity picking up a little bit. China's reopened, so that's quite positive for those commodities. So moving on to currency, this is one area where the deliberate policy we have in the portfolios continues to pay off. That's one of the features why we've performed really well through this period. So the Kiwi has appreciated a bit against the US over the last 6 months, but the last few weeks, and especially just at the time of this recording, we've just had the inflation number for New Zealand, and so that's seen the Kiwi sell off a bit. But prior to that, the Kiwi had strengthened against the US dollar because we were actually on the charge in terms of the central bank, the Reserve Bank, as you saw with Gemma's presentation, that we're actually a lot tighter, and we were in a harder tightening cycle than the US. So that's actually seen the Kiwi appreciate against the US over the last 6 months, and appreciate against the Aussie as well, because as we mentioned before, the Australian Central Bank and the New Zealand Central Bank, Reserve Bank, are at different ends of the spectrum. New Zealand Bank is very what we call hawkish, or a lot wanting to raise interest rates a lot higher and harder, whereas as we know with the Reserve Bank of Australia, they've been a lot slower out of the blocks. They've raised interest rates to a much lower level, and just recently they just took a pause. So that's seen the Kiwi appreciate against those currencies. But as the Reserve Bank continues on with this tightening cycle, and the prospect that may push New Zealand towards or we have a higher probability that New Zealand would have a harder landing, i.e. a recession that's a bit worse than if we had lower interest rates. That means that the currency will possibly exhibit some softness. Of course, we're not trying to take bets on which way it's going. We just have deliberate exposures that give us really good diversification features in the portfolio. So the portfolios have continued to do really well, and with the positive uptick in the markets, the portfolios have benefited from that. And the nice feature with our portfolios is that they're coming off a much higher low than with other parts of the market out there. And that's actually one of the objectives that we aim for all the time, is just having more of a consistent performance and consistent outcome for you, our clients, because it's much better having that more consistent level. A nice feature of that process is that the portfolios don't have as much what we call downside capture. When markets fall, they don't fall as much, and so when markets recover, we come off these higher lows. The portfolios haven't dropped as much, and then when the markets recover, they pick up off these higher lows, which is a really nice outcome for our clients. And as you will have seen in your results, that's what's occurring. And so the performance drivers continue to be our core holdings, but what's really setting these portfolios apart through this period, as we mentioned before, is we have very effective diversification in terms of our equities. Our equity core holding, for example, has over 5,000 stocks, where other people are using 130, 45s and so on. Much more concentration of risks, which we've actually seen play out, which means they've had more extreme downside. And so that diversification in that equity position has really paid off quite nicely. Cash and fixed income positions have paid off very well. We haven't had as big a bond holdings, and that's been a huge benefit in the portfolios. The deliberate currency exposure, as I mentioned before, and then the multi-strategy funds that we employ in the portfolios have also paid off very well. And the way they've worked is that they have what we call non-correlated performance. And so as equity markets have dropped, these multi-strategy funds have actually had good positive performance. And so that's really provided very good diversification for the portfolios. And so those factors have contributed to the performance of the portfolios through this period. And we're very happy with the performance of the portfolios through this period. As we said, they've come off higher lows, and they've delivered the right sort of consistent results for you. And we're very happy in terms of the research we've done, and that the portfolios and the components are reflecting the sort of performance that we would expect given the environment. So moving forward, also, as you heard from Gemma, the macro themes are in play: inflation, interest rates, and now this next one, which is the markets are sitting there and trying to figure out, are we going to have a soft landing or a hard landing? Mainly, are we going to slow down a bit, or are we going to have a major recession? And so that's what's driving the markets at the moment. But what you can have confidence in is the portfolios are positioned very well going forward. They're very well diversified, and they're very well positioned to take advantage of whatever environment we are moving into. Thanks for joining us. Look out for our other videos. There's some great information there on our channel, all sorts of different topics covered in those videos. We're actually recording one on inflation and term deposits right now. Catch you next time.